Halal Finance. How do Islamic banks manage liquidity problems? Imagine a bank that never charges interest and always follows strict ethical rules. That's what Islamic banks do. But managing cash and assets quickly to meet short-term needs can be tricky without conventional tools. So how do they keep their money flowing smoothly? Let's find out. Islamic banks use special financial tools that are compliant with Sharia law. These tools avoid interest, which is forbidden, and focus on risk sharing and asset-backed transactions. One common method is Commodity Murabaha. Here, the bank buys a commodity, like metals or agricultural products, and sells it to a customer at a deferred price with a profit margin. This helps the bank get cash quickly without interest. Another popular tool is Sukuk, often called Islamic bonds. These are backed by tangible assets or services, like property or leasing rights. Short-term Sukuk ijara, which are leasing contracts, are used to raise funds fast. Sukuk al-Wakala involves appointing an agent to invest funds under specific terms, providing another way to manage liquidity. Islamic banks also use Islamic repos. Unlike traditional repurchase agreements that involve interest, Islamic repos are structured as a sale of an asset with a promise to buy it back later at a pre-agreed price. This setup allows banks to access cash without breaking Islamic rules. Managing cash flow carefully is vital. Banks project their daily funding needs by analyzing their assets, liabilities, and off-balance sheet items. This helps them plan ahead and avoid liquidity shortages. They also diversify their funding sources, avoiding reliance on a single type of funding or maturity date. They keep high-quality liquid assets ready, like cash or easily sellable assets, to meet sudden needs. However, Islamic banks face some challenges. They cannot easily access conventional interbank markets because there are fewer Sharia-compliant instruments available globally. This limits their ability to manage short-term liquidity as flexibly as regular banks. Some central banks offer Islamic liquidity facilities, like Islamic-based lending options, to help banks during tight times. Overall, Islamic banks combine these tools and strategies to keep their money moving while sticking to their principles. As the global market for Islamic financial products grows, options for liquidity management are improving. Still, differences in Sharia interpretations across countries and the limited development of Islamic money markets mean they face ongoing hurdles. In essence, Islamic banks relying on asset-backed, interest-free financial instruments, careful planning, and diversified funding sources. These methods help them maintain liquidity while staying true to their ethical and legal standards. This careful balancing act ensures they can meet their short-term obligations without compromising their core principles.